Hey, all right, everybody. TGIF, huh? We got a long weekend, so be mindful of the risk and really know what you own as we go into this weekend. There's been some conspiracy hints that we could possibly see, the escalation in the war vibes. And so by the time we come back on Tuesday, the market could have seen a significant shift to the downside. So just kind of keep that in mind. Otherwise, we're going to get inflation data today. January is always really tricky. It's where companies and corporations often set their prices. And that implies that last year, when the tariffs were finally enacted in the February, March, and then that turn in April off the lows with the capitulation, we had already passed January and we had already passed that time frame where companies and corporations would be able to pass through those costs. It might seem like too little too late, but we have to worry that throughout this past year, companies and corporations have been looking forward to January to elevate those prices. So when we get this data today, we're going to be parsing through the January numbers and this increase. Now, we have the tariffs from last year to worry about with this January print, but it's not just that, right? It's everything that they want to do for the year. It's often this is their uh, greatest opportunity to adjust that pressure, right? So we could see change in prices that might look like an elevation to inflation. That could go to the heart of the Fed's dual mandate if the numbers are misrepresented or misunderstood. The markets also might need time to digest this data and parse it out a little bit. So we could see an initial move of one and then a different move either later in the day or next week once the market has had time to digest it and maybe reconsider what they think it means going forward. Right. So we have a lot on the table this morning with this inflation print. We can see the White House risk for today is at 75. That is extreme risk based on current schedule. So let's just take a look at this schedule. It looks like 130 could be the biggest impact for today. He's going to be making remarks to Fort Bragg military families. But it also could be at some other point today, right? So just be mindful of this, especially if they're going to make comments to the press or have any sort of briefing or take questions, is that's usually what leads to the gotchas and the misrepresentation of answers that can really just skew things out of whack. So big risk coming out of the White House on top of the uncertainty over the inflation data that we're going to get today. All right, Japan is up 0.5%. Small caps down less than a quarter than the S&P, the NASDAQ, and the Dow, all down around that 0.25%. Tight knit this morning. They're all bunched together. Then China down 0.5%. And us just sitting around waiting on data. So 8:30 is the big one for the calendar event. Once we get past this calendar event, then we really just have to focus on anybody who's out there chipping teeth. We can see that Bissett is done with his interview. The Bank of England, this dude Pill, is still chipping teeth. And then after that, the White House risk. It's not that bad for a Friday, yeah? You like it. I wouldn't worry much about the oil rig count. This number doesn't change very much, and when it does, it's usually when they are taking some rigs offline for maintenance, or if they bring in a whole new class of rigs and then need to set them up. But otherwise, the number doesn't fluctuate that much, and it shouldn't, right? They'll telegraph that well in advance. So this 2 p.m. rig count event shouldn't be anything to worry about. I worked on those rigs for most of my life. It is Friday the 13th. A really good friend of mine is headed to the hospital this morning so that they can deliver their second baby. And they're going to induce labor for that baby. And I kept asking them, why do it on a 13th? You know, it's 40 weeks. So, I mean, you can schedule it on any day. You can wait for tomorrow and do it on Valentine's Day. You could, do it yesterday and skip ever having a birthday on Friday the 13th. So, like, why today? But that's what they wanted to do. So you want to keep your eye on the FedWatch tool. After the CPI data comes in today, we want to see if we get significant changes in this space. And we're not looking for 1 or 2 points, right? We want to see 15 to 20, even 25, 30 big changes, right? If it's just minute changes to the values, then it's not really a big deal. Don't need to worry about it all that much, right? So if we see the number go from 31 to 61, well, then that would certainly get my attention, and that would be a number that we'd want to pay particular attention to. Right now, the changes that had slowly been priced in was farther out on the curve, June and July. So if the data today radically alters the landscape, we could see something like April getting jacked up. Maybe March. I kind of feel that March is a little too close. It might not be, but I think it's too close, right? So certainly we have to look. I wouldn't ignore March when I'm poking around in here trying to see if they're pricing in anything. But it's likely that what we see shift, if there is a shift to the positioning in here, the earliest I think we'll start to really see it would be April or June. So let's let that play out. Just keep your eye on it through the day. Like I said before, it's not like you have to sit there and stare at these charts all day. Just drop in, poke around, leave it for a few hours, come back and check again. If it's subtle, we don't care anyways, right? We're not looking for subtle. We're looking for radical. AI disruption continues to be the narrative that that drumbeat in the background that the market continues to dance to. All right, so the Gamma Lab is talking about the SPX 6800 is likely in play for Friday. This level should provide support, and if that support is broken, then we could see a correction accelerate significantly. CTA funds are selling and vol control funds are selling. The ES found the put wall in the overnight. The call wall is so far away, it's not even worth focusing on. You can see the zero gamma line, and we are firmly underneath it. This puts us in that environment where it's like a little bit of a feedback loop, right? Now, Volland argues that we're not always in this sort of regime, right? They use a word, paradigm. So they argue that the paradigm shifts and that what I'm about to talk about isn't always the case. And I like that argument because if you've traded for a while, you've come to realize that the markets aren't always one kind or another, right? They shift. And so it makes sense that the narrative on what dealers are doing would also shift, that they won't always be in this particular sort of regime or paradigm. But generally speaking, if we lean on spot gamma style concepts, if we're below zero gamma and the market sells off and starts to fall, the dealers will sell into that selling, which creates a feedback loop. We fall, that changes the balance of their neutral position, and they have to sell even more to get back into a neutral position. But because they sold even more, that shifted the market. It dumps us lower, and because we dumped lower, they're no longer in balance. They have to go in and sell more. It's a feedback loop, right? So that's the sort of scenario that is in play when we're below the zero gamma line. Now, if we start to rise, the same feedback loop applies. They're trying to remain delta neutral. So if we start to rally, they no longer are neutral, and they have to buy into that buying to get back to a neutral stance. Unfortunately, their buying adds to the buying. That drives price even higher. They're no longer in balance. They have to buy more to get back to neutral. That pushes the market even higher, and then they're out of balance again. Feedback loop. Now, that sort of behavior is what happens when we're below the zero gamma line. And we're not talking about just a wick down below the zero and then, dancing around that line 50 points above and below and just sort of hovering in that area. We're talking about getting firmly and completely underneath zero gamma, closing underneath it, opening back up and keeping underneath it, maybe even extending our depth below it. So we are firmly entrenched in a zero gamma environment. And we have to believe that this feedback loop currently applies. And if you think about those really big candles that you see when markets are violent, then that would make sense, right? If dealers are selling into selling and buying into buying, that will make markets take extreme moves on day-to-day basis, and it increases how far a market can go from one day to the next. So that kind of helps explain why bear markets have bigger candles. So we want to be mindful of that today, that the market can make really big moves because we're in a zero gamma environment. Haven't got the volume yet. We'll just have to wait up on it a little bit. It says 129 so far, even if the line hasn't printed yet. 179 is a little elevated for this time of the morning, especially in front of an economic data print. Generally speaking, we anticipate that dealers, funds, firms, that they pause in front of a big event, and or they would hedge in front of it, which still, even in that hedging, shouldn't cause an elevation in the volumes. So if they were going to sit out and wait for data, we shouldn't see 129,000 here. So that kind of implies that they are not sitting out waiting for data. Bring it out to the daily here for a moment before we shift to the other chart. We talked about this IX10 positioning and how we needed to get out of the box, and that because we were in a box, when we did finally leave it, we could leave it with violence. And there was no directional bias to that statement. So we could have left to the upside as easily as we had left to the downside. But getting out of the box was the idea. We knew we couldn't stay there forever, and that when we did finally leave, it likely would happen with velocity. And check, we got that. We also are through the midpoint from Friday, the last big bar that we had to evaluate. We're through that midpoint, and we are through the midpoint of this last leg here. So 68.60 would just kind of round it there a little bit as the midpoint from Friday, the bar of control. If we get below 6,800, then the acceleration into 6750 should increase, right? We should get down there a lot faster once we get below that 6,800. But I did mention yesterday, if we got underneath 6950, that 6850 was on the table because, well, we're running 50s. So now we're through the 6850, and that puts 6750 front and center, and that would be the next target lower. We also now have a valid lower high. We talked about this earlier in the week. When we were just dancing around with these three bars, we didn't yet have that lower high, because if we had shot out of this thing to the upside, then we wouldn't have had a lower high, right? But that's not what happened. So now we've got our lower high, and we've got one lower low. We need another lower low, and we need another lower high. because this is the high. You need 2 lower lows and 2 lower highs to define a trend. I call it a full set. We don't have a full set. We've only got 1 lower high and 1 lower low. With price in this range, the market, broadly speaking, is not bearish. This is the same range that we've been in for a long time. All year, if we want to just make it sound like forever. We've been in this range all year. Of course, that's only, 5 weeks, but whatever. So if we want to start talking about getting bearish and really reshaping our portfolios, then we've got to get completely away from that 6750, right? Maybe 6700, 6650. Get underneath that 200-day moving average, and then you would get my attention. But as long as we're still just within this last leg, we got nothing. I wouldn't get all bared up just because of that. Of course, that also means we're not bullish because we're still just in that leg, yeah? Yeah. Aha, okay, there they are. So they are hedging this morning. Even with the elevated volume, they're doing both. They're trading it and they're hedging it. This isn't my opinion. I'm not guessing or assuming that they are hedging. I'm just straight up telling you they're hedging. We know this. It's fact. We can see it right here with the market maker move. Now, if you don't have Thinkorswim, you don't have something that shows you the market maker move. But that doesn't mean you can't find it. So you got to go into the options chain and look at the implied vol average. The number on the side here, any options broker out there should have that number. It might be in the middle. Sometimes brokers will put it in between the calls and the puts, but otherwise you'll find it on the side. And what you're looking for is if the front number is bigger than the next number out. If it is, then you have a market maker move. Now, this was created by the developers of the Thinkorswim platform way back in the day when it was Tom Sosnoff and Doc Severson and all those guys, right? The whole crew. I believe Kaufman is the one that actually came up with this, but either way, it's an in-house thing. They made it up. So you won't find it anywhere else, but you can use any options table and spot it. If you want to learn more about the market maker move, just Google market maker move. Schwab owns this now, and they've got a couple articles that they wrote that explains market maker move. They never talk about futures in those articles. They usually talk about binary events like earnings and drug trials, things like that. But still, you can learn about it and see what they have to say about it. So we know that they're hedging today, right? It's very likely that they're hedging for CPI. I think that's a safe assumption, but we can't say that with certainty because who knows, right? They didn't ask me. So if we get past CPI and that number does not begin to change and go lower, say it holds where it is or it even continues to rise and go higher, then we were wrong. They weren't hedging because of CPI. I'm pretty comfortable saying that they're hedging for CPI, but I'm also willing to admit that I can be wrong and that I want to continue to monitor that number just to validate and make sure they really were hedging just for CPI. That way we don't let our guard down after CPI and get run right the hell over in case there actually is something out there this morning besides CPI that they're worried about. I've learned that lesson the hard way at some point in my trading career, and I don't tend to make it twice. We didn't quite hit the edge of the ADR half down here, but close is close enough. So if we don't put in a new lower low, which really at this point any lower and we're going to hit it, but if we don't turn back and print a lower low, then it's reasonable to assume we're going to hit this other side, right? Because if we get to one side early enough, we can go to the other side by the end of the day. Going to the other side by the end of the day would not be bullish or bearish, right? Because we could have been at the high and be making the same statement. It's just the way price moves in the wave form that it takes, right? That's just how price moves. Just come out here for a second, we can see that wave movement, right? Same thing here, same thing here. So it's not bullish or bearish. It's just, hey, we're at the bottom part of the wave. It makes sense that we're going to rise up and get to the upper part of the wave. That would be a minor TRB setup, but it would also be just working our way through the midpoint of our own Globex and then getting a breakout of Globex and targeting this upper ADR line. So that's a really simple gift at this point. We've got nice, clean price action. All we've got to do is get that trend line breakover, get back to the top of the ADR of the Globex, break out, and get to the ADR line. If we break our own Globex low, then we'll challenge the ADR half. Underneath that, we take the full ADR, and then we start running our 50s again. We are inside day breakout, so if we turn back and get through our own Globex high, we'll be back inside of yesterday's range. And if we get inside that range, we need to keep it. Today's floor pivot is significantly lower than yesterday's pivot. That's bearish. Price opened underneath that pivot. That's also bearish. We are firmly underneath the weekly pivot. That's bearish. We have not yet hit our daily floor pivot, and that is mildly bullish, simply because we'll be looking for price to make that move up and hit that floor pivot, simply because that's what price tends to do more often than not, right? So most of the time, price will hit that daily floor pivot. That implies we're going to go up because we haven't hit that pivot yet. I don't know how bullish that makes me feel, though, right? That's like throwing a ball in the water and then watching it rise up simply because it has to, right? It's just what a ball does. Because of the expansion yesterday, today's S&R lines are really wide. Just kind of zoom out here for a moment to get some perspective on that width. Compared to yesterday, here's yesterday. It's a very narrow range. Let's do it like this. You can see today the lower edge 6,600 and the upper edge 7,200. That's really big, right? Compared to yesterday, it's really big. These are just math formulas. So we made a large move in the market yesterday that caused today's lines to be really wide. That's it. That's where it all comes down from, right? So with this S&R line above us and below us, if we continue to move to the downside and break the ADR half, we've got to get through S1 to be able to continue that move lower. There's a market logic that talks about getting from an S1 to an R2. That would be 70.50 by the end of the day. But generally, that kind of logic fits in a market that has already been running up, and we're trying to gauge how far this pullback would be before we make the next leg up and where that next leg would stop. So getting an S1 for an R2 makes perfect sense when we see it in that sort of context, right? But look at what we're dealing with here, and then think about what I just drew. That doesn't line up, all right? So getting an S1 to an R2 in this environment really doesn't make sense unless we see it play out another way. We're making these waves here. If we were to fall down into an S1 and look for a rally into an R2, then we would be looking for a higher low and that turn to bring us back in the other direction. That would be 67. Nope, that would be S2. S1 is 6,800. So yeah, I drew that right. Right in here. But it doesn't really fit. So at best, I would be looking for an S1 to R1. Or we break right through that S1 and we keep going to the downside. And that would fit this daily scenario with us just continuing this move. And that gives us 67.50. If we break back up and get through our Globex high, target the daily floor pivot first and then the weekly pivot. We got to get above that weekly pivot so that we can challenge the R1 level. So at least we got targets to the upside if we do begin to make that journey. For that move to the upside, this is going to be a significant speed bump. It's about 20 points wide and it's overhead, so we're going to have a hard time cutting through that level. Now for the week, we've got that distribution across the top. So if we can get back above, say, 69.32 cog line, which is the value area low, then we can get back into this other zone up here, which is about 40 points. It really seems like the best case scenario for today, which really could wrap us up for the week, is that we end up developing a second distribution and we just end the week with this low being the low for the week. So we've already got that first distribution. We would just look for price to run back up, stall out around 6,900, and we build that level out, and we just end the week right here in that second distribution. If we do make a break for the downside and aim for that 67.50, I think we've got a level. Yeah, there it is. Out yonder. Right there. So if we're going to get to 67.50, we've got to cut through this point of control. Now we've tagged it here and we've tagged it here. So we don't know how much is still down in that area. But look at the volume profile in this area. Just take that back off for a moment. It's not exactly shallow, but it isn't like a big volume profile point of control level, right? So we have a little bit here. It doesn't seem like it's a whole lot. And then on the other one, it was even thinner, right? Put that line back for a moment. this area here. It's really thin. All right, so we didn't put a lot in there. There's not much of a footprint at this point, and it's likely if we go back into that area, 67.77 or 67.80, it's likely we'll build out another footprint there. So look for a significant speed bump. $10-day, 30-minute volume profile and TPO. TPO really, it doesn't look bad, but the volume profile isn't all that pretty. Nothing here is helping us out. We can see the value area overhead lining up around 6,900 and it goes up to 7,000 with the point of control around 63. But it's so far away from us and there's really no insight that's going to help us out. This point of control isn't going to move anytime soon. We have at least a week with it sitting at that current location unless we can build out a new spot really fast. Well, that would imply that we get stalled somewhere and then we just churn and we build out a new footprint. We got nothing at this point. So everything is over our head. If we try to make a move back in that direction, it's likely going to be a strain. We got a new VPOC from yesterday. This is where the greatest amount of trading took place. And until we hit that level, we want to keep that line on there. Now, I don't zoom in and get it to the tick perfect. That's not really my goal. But you do you. If you want to zoom in and get it right down to the nut and bolt, to the tick perfect, then do that. Me, that's close enough. And I'm going to carry that forward until we hit it. It might be today, it could be 3 weeks from now, right? When we zoom out, if I was to have left these profiles on, we could spot targets from, say, this one back here. I was actually on TradingView yesterday afternoon, and it has these profiles, which will carry that line for you automatically. And there was a point of control from back here. It might have been the December area, right? It might have actually been. No, I'm right. It was back here. The reason I'm pointing this out is there's a contract change, right? Somewhere in November, we had a point of control that was running forward. Then we had our contract change. Now, I've always been a believer that once we've changed those contracts, that point of control really doesn't have any value because, well, those contracts don't exist anymore. But looking at the profile yesterday and that carried forward point of control, price was still responding at that level. So I might have to rethink things on that. Maybe it's worth carrying them forward even if we have had a change in contracts. Either way, we've got the VPOC marked. Now it's overhead. If we make a move to the upside, we're going to have to work through that level. And if we can get through it, things got really shallow yesterday, right through this area, and price moves quickly through shallow areas more often than not. So if we break back to the upside and we get through this significant resistance, we could move very swiftly through that zone and then get hung up somewhere around 69.82, which is an old school cog line that we don't use anymore, but still proves to be relevant. It is a double distribution yesterday, right? It's with an ugly, wide value area that isn't really helpful, but we'll take it. Take whatever we can get at this point. All right, like we do every Friday, We want to evaluate next week's weekly expected move range and compare it to our current week. There's two pieces of the formula that builds these ranges. One piece is time, the other is volatility. The week that we are in right now was a 5-day week, right? Thanks, Captain Obvious. But next week is a 4-day week. So next week's range should be narrower simply because there's less days. If you can travel 60 miles in an hour, how far can you travel if I only give you 45 minutes? Not as far, right? Unless you speed up. So if you want to get those 60 miles in 45 minutes rather than getting 60 miles in 1 hour, you're going to have to go faster. So if we have the same range as the current week, but next week, then what changed? Volatility increased. And what I just showed here is that next week's range is bigger than our current week's range. That's volatility. They didn't just go 60 miles in 45 minutes. They went 90 miles in 45 minutes. Now the day isn't done yet, and this range can still shift. We don't know how big it's going to be until the end of the day. But at this point, next week has a lot of volatility getting priced into it. One of the things we know about this volatility and range is that it's very likely not based on a calendar event. If it was CPI, PPI, non-farm payrolls, it would actually be a narrow range because those calendar events suppress volatility until we get into the event itself. So it's not that. It's not a calendar event. The market is worried about something else, and it's jacking the volatility up and giving us this really wide range. We are in a negative gamma environment, which is what we spoke about at the beginning of this stream, with the feedback loops and the big candles and the sweeping moves that could be made in both directions. And that very likely can be attributed or added to the why behind why is our range so big for next week. So we will revisit this on Tuesday and see what the range looks like. But at this point, the market is worried about next week. It wouldn't hurt to shop around for some lottos, really cheap puts. If you can't find those puts on SPY or QQQ, try something like SMH, right? That's something that Spot Gamma does quite often when they're looking for a bullish or a bearish move in the indexes. They'll just use SMH because it's going to be affected the same way, and yet the options are often just cheaper, less risk, right? So, be nimble, shop around. Remember, it's a lottery ticket. You're just guessing or assuming that we could have a big move up or down. I mean, shoot, you could shop around for calls if you wanted to. The idea is we could make some big moves next week. But they should be lottery tickets. Don't pony up a couple of grand on the theory that we're going to make a big move, because at this point, we don't know if we're going to get that big move. We are below the 10-week by 1%. This very well could be the reset we've been looking for. It still needs to play out to see what we're going to get from it. But I like the fact that we're finally underneath that 10-week. We kind of needed it. We've been looking for it for a while. At least I have. So now we've got it. What we don't want is a continuation. So we don't want this, right? We want one of these little dips, one-day wonders, where we get underneath it and we come right back out again. So none of this. We don't know until it plays out, but that's what we want to focus on, is we want to get back above that 10-week. We are 1.25% below the 10-day. It's kind of the same thing. We don't want an extended stay below the 10-day. We want to get back up through that level. It can happen very fast. So just because we're under there now doesn't mean we need to end the day below that level. And there's plenty of examples in bearish markets, like here with the big fat bars, and here where we're underneath the 10, where suddenly one day we're down 6% below the 10, and the next day we're up 2% above the 10. So the change can happen swiftly. When we examine this and ask the question, have we moved too far, too fast, and does it owe us a pullback or a mean reversion in the other direction? And the answer at the moment is not yet. 2% or below 2, we could start to change our answer and begin to look for some sort of mean reversion or a change to that method. But at this point, no, we have not moved too far, too fast, and it does not owe us a pullback in the other direction yet. Now, today we're only down 0.5%. So if we was to, drop another 0.5% or even a full percent from here so that the ES is down 1.5% on the day, that very likely would be a nice spark for having moved too far, too fast and changing the direction and moving back the other way. Bitcoin is up this morning with gold miners, and really that's all we've got that is up this morning. Everything else is either down or flat. So it should be pretty easy to see if we spark a rally on a day like this, everything that's down has to flip. So that'll be easy to spot. Otherwise, if the weakness continues, then we'll just look for, say, a high correlation coefficient on a day like this if we want to see that continuation. Look for the advancing minus the declining issues to get above 90%, trigger something like your alpha protocols or something like that. All right, so high correlation would be your best bet, especially for a downside move, right? That'd be the way to play it. If you're looking for an increase to the downside and a change in the rate of change increase, then we want everything else to pile on and push us lower, right? That's what we want to be looking for. Otherwise, if we keep what we've got now, then we're very likely just going to digest the move, hold the line, and go into the close nice and quiet. And I'm having a hard time believing we're going to go quietly into the close today. All right, everybody, you got the levels. Keep your eye on the clock. Remember, we got White House risk today. Be careful, be safe, enjoy your long weekend. I'll see y'all on Tuesday.